Shibani, hi, welcome on board. Thank you so much for making time and speaking with us. Of course, we'll discuss the auto space in detail, but I wanted to begin by discussing the tire stocks today because they definitely are on the spotlight. Seat is up as much as 18%. Polo Tires, JK Tire, you name many of these counters and they're flying away. My question is, the entire tailwind of the crude derivatives falling and the raw material prices being favorable is known, right? What do you think is happening suddenly in these counters that explains the move?
Yeah, hi, good afternoon. So when you look at the entire auto and auto ancillary pack, one, as you correctly pointed out, that with input costs coming off, there is that margin tailwind, which is possibly known. But as you start seeing that in terms of numbers, that will start getting built in. This is also a segment which, in terms of valuation, looks fairly reasonable. So that's the second aspect. And the third aspect is if you look at overall growth, especially in terms of replacement demand, the replacement demand, which was missing for a long period of time, should also aid volume growth going forward as well. So, therefore, this whole earnings growth trajectory for the segment led by volume growth, margins also expanding, and valuations being in your favor is possibly something that is resulting in positivity where the entire auto ang space is concerned. So if you look at the entire auto pack and the auto anch segment, this is one space where we have been fairly positive, and our positivity at this point in time at current valuations remains.
You also believe that they're in a sweet spot given that crude seems to have stabilized and this is going to lead to an uptick as well for their GRMs?
Yeah, so if you look at the entire oil and gas space, specifically for the OMCs in the near term, because crude has stabilized, we would possibly see improvement in terms of marketing margins and therefore recoupment of some of the losses that they had made, and therefore moving from loss to profitability. If you look at pure GRMs have actually come off. However, the marketing margin improvement should help offset any kind of weakness that you see on the refining side. Also, the entire pack is trading at fairly attractive valuations, and that is something that is possibly a opportunity from a valuation perspective. However, within the oil and gas space, a more secular segment where we have been positive on has been on the gas utility space. What we believe is that incrementally you should start seeing volume growth uptick where the demand goes, and that should aid in terms of overall profitability and growth. The entire move that you have seen in terms of adoption of or moving to a more cleaner, greener fuel option, that is likely to be something that we will see over the period of time. And therefore, within the oil and gas space, structurally, we prefer the gas utility pack. But in the near term, you do see that potential upside where OMCs are concerned, primarily because of improvement on the marketing side.
The insurance sector, let's just highlight that as well because the June general insurance data has just come out. The non-life insurance sector has actually seen a growth of about 14% on a year-on-year basis. Non-life insurance industry premiums as well have gone up. The private sector general insurance companies have actually posted a growth of nearly about 17%, and PSU general insurance companies have seen a growth of about 7% on a year-on-year basis. Standalone health insurers, they've seen a growth of a staggering 23.5%. Star Health premiums are up almost about 19%. New India Assurance premium, that's seen a growth of about 5%. And ICICI Lombard as well has posted a growth of about 21% on a year-on-year basis. In fact, the premiums as well have grown now to 1900 plus thereabouts from the earlier 1588 thereabouts or so. Shibani, your take on insurance, and I'm going to put the entire basket here, both the standalone players as well as the, the banking ancillaries.
Yeah, so let's talk about insurance in two parts. One, the life, and the second is the general insurance segment. So, starting with general insurance, clearly we are starting to see improvement in terms of monthly numbers, and that's showing up in terms of the premium growth seeing across for the industry as a whole. Now, within that, the segments which are clearly doing well, one is health, and within that, retail health is showing signs of improvement. The second is segments such as fire, etc., is also seeing fairly strong growth. The only segment where there is significant amount of competition and therefore pricing pressure has been the motor segment, and that's been a drag. But overall, we believe that even on the GI side, after a fairly long period of time, you are starting to see growth coming back. While it will still take time for some of these companies companies to get back to underwriting profitability, but at the margin, growth coming back is good news for the sector. Now, similarly, on the life insurance side, the players have gone through significant amount of turmoil, both in terms of demand coming off as well as the tax changes that were announced recently. However, now at the margin, what we are starting to possibly see, and this is a trend that needs to be watched out for, is whether protection growth comes back, and that could offset some of the impact because of the tax changes on the higher ticket non-par segment. So overall, life insurance as a space as well as GI as a space have been underperformers over the last 2 years. And possibly we are now coming to a point where things seem to be bottoming out. And at the margin, you should start seeing improvement, both in terms of growth as well as in terms of the overall profitability. However, one caveat for life as a segment, margins, which were the key drivers for the overall VNB growth, will possibly come off, and APE growth or premium growth will be the key driver to drive the overall VNB growth for the sector.
That's a take.
Before we let you go, just wanted to understand as a house call, where do you think that the markets are, which are the underrated sectors right now, according to you, where you do think that there is further headroom to go, and what's looking ripe right now?
Yeah, so at a headline market level, clearly now valuations have moved up to about one standard deviation above long-term averages. However, the most important factor is that earnings trajectory continues to remain very strong. And if you look at expectations of earnings growth over the next 2 years, India clearly stands out on a relative context with the highest earnings growth expectations. And hence, delivery of earnings for the market from here on at these current valuations becomes important. What we believe is that, if you look at sectors at this point in time, you need to continue to focus on sectors where there is earnings growth visibility. While you're right that valuations have moved up in most pockets, however, we continue to believe that domestic facing sectors are still better placed because earnings visibility is still fairly strong over the next few years, aided by margin tailwinds as well as volume growth starting to pick up. So sectors that we are positive on continue to remain the capital good industrial space. We continue to believe that banks are fairly well placed, and here valuations are reasonable in the context of the return ratio improvement that you have seen over the last 2 years. The other spaces where we are positive on include auto, cement. These are some of the other segments where we believe that there is still some headroom for valuation re-rating, given the kind of earnings growth expectation which remains strong for this segment. In terms of where we are still a little bit cautious, we continue to be cautious on global cyclicals, which include metals. We are somewhat still cautious on IT. While I might caveat that large cap IT valuations have corrected quite sharply, and therefore for large cap IT, significant downside may be limited, but there are still some uncertainties with respect to growth and margin outlook, which is weighing on the sector.
Leave it at that. Good to have you on the show as always. Let's just mark